Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello subscribers, welcome to the Fast Profits Daily. I am Brijesh Bhatia. The COVID cases are again back into the on the rising streak. I would say the cases in the last couple of weeks have seen a rising. We have seen images floating out of the China where the beds are full. The people on the streets are with the oxygen and the necessities to fight against the COVID. We have seen South Korea numbers, the active case numbers have been increasing steadily. There are few countries where the corona cases are slow and steady picking up. If I just look at the one chart which is from the worldometer info, the active cases, it has seen a slight uptick into the recent times for last few weeks. Post the second wave, when the things were looking good or things were coming back on track again, the COVID cases have been steadily or I would say gradually increasing, though it has been slight uptick over here, but you never know what kind of numbers would increase or the spreads. We have seen or we have been experienced such kind of scenarios in 2020, though early 2000 the late 2019 or early 2020, people were not very sure of the virus or the quantum of the virus being spread. But as the country started lockdowning, most of the countries we have seen studying or following the rule of lockdown. And India, in the third week of the March, we have seen lockdown back into the markets. If I look at 2020 was a severe fall. April, May, we started recovering. The V-shaped recovery happened, and the one sector that stood out with a no-brainer was the pharma sector. Again, the second sector was the IT, but in this video, I'll be discussing about the pharma sector. With the cases rising again, should you invest into the pharma stocks? Can the pharma stocks rally like the history which happened in 2020? The first point I would look at, though the pandemic was a newer in 2020, we have experienced that pandemic, and the scenario has been very very different now compared to the 2020. We have been most of they have been vaccinated. We know the precautions to be taken out now. Though the active cases are still seen a slight uptick, I would not say that the pace of the spread is very very faster. You never know what kind of pace it would hold probably next 1 month or 2 months down the line. But at current point in time, I think if I just look at the technical parameters onto the charts of the pharma index or pharma stock, the things are exactly opposite what happened in 2020. So let's look at the first over here, the constituents and weights of the pharma index before we look at the charts of or decode the chart of the pharma index. So first, if I just look at the constituents weights, it's the top of the table is the Sun Pharma with around 25% weights, followed by Cipla 14% weights, Divis Lab around 12% weights, Dr. Reddy around 12% weight, Divis around 10% weights, and Lupin around 4% weights. So these top five, I would say, constitute around 60 to 63% weights, and then it followed by a single digit stocks. So there are around 20 stocks into the pharma index, which weights right from around 25% to 1% weights. Granules being the lowest with 1% weight. The momentum over here into the pharma index, though we have seen a rally of around 60% in 2020, it may or may not repeat in 2023. As we are stepping into the 2023, it will be very very important to look at the pharma index, how they pan out over the next 12 months. So let's look at the charts over here, and let's start with the top down approach with the monthly chart. Now, if I just look at the monthly chart over here, back in 2015, 16, 17, or probably I would say from 2010, till 2015-16, Pharma index was one of the best outperforming index if I just look at the percentage term. But since then, it's lost its momentum. The defensive sector at that point in time, people started going aggressive onto the banking space, onto the IT space, onto the auto space, and some of the mid caps also started outperforming by a big number. And again, the money flew from the pharma stocks to these aggressive stocks. The defensive, it was no more the defensive bet, considering the opportunities back into the auto, IT, and banking space. The highs was taken out back in 2020-21 when index broke its the previous high during the corona times. 2020-21 was again one of the best rally which have been seen into the pharma index in the shorter span of time. The rally again fizzled out back in 2021-22. Now the top was made in like January, February, when index have seen a newer highs. October was again a fresh highs, but it similarly didn't sustain, and we have seen a slow steady falling in 2022. Gradually, if I just look at the move right from 2021 highs back to 2022 towards the lows, we are looking at the similar high, which is generally the top double top pattern as per the technical analysis. Though the pattern has been not has been confirmed yet, but looking at the highs, the structure seems very. I believe till the highs are not taken out, probably 16,000 is convincingly not taken out. The hang of the double top can be there for to keep a cautious sign onto the pharma index, I would say. If I just look at the top down, I will move on to the weekly chart over here. Two things over here. If you look at right from 2010 rally, as I said, we have seen a huge rally. 2017 we witnessed a death cross. So if I look at the blue line over here, it's 50 days, 50 weekly average exponential moving average, and the orange line if you look at, which is 200 weekly exponential moving average. Now we saw a death cross coming in 2017-18. So basically, what is death cross? The death cross is when your 50 medium term average crosses below the long term average of 200. Generally, it is done onto the daily chart, but if you keep considering the long term chart over here onto the weekly space, we saw death cross coming on to the 2017, the pharma index continue. We saw 2020 recovery over here, and we saw again a golden cross over here. Now, importantly, if I just look at the golden cross, the rally was fast and furious, and we saw it. A golden cross is basically the bullish sign when the 50 crosses over above the 200 average. The orange line, the blue line again crossing above the 200, which is the orange line. It is a sign of a bullish trend. But at current point in time, if I just look at the index is consolidating or trending between the 50 and 200. The slope of 50 over here, which is the blue line, is trending southwards. The slope of the orange line, which is 200, is onto the positive side. At any point in time, they may meet again. But at current point in time, I believe the consolidation in the range doesn't indicate that the momentum is very bullish. I will wait for a momentum to change out onto the positive side, or the index taking out above the 50 convincingly and trending higher with a faster rally. That point in time, I may believe that yes, the weekly scales is changing on after the golden cross. As of now, the index has taken support right at the orange line, which is 200 weekly exponential moving average, which is again a positive sign over here. I will not say it is a negative sign, but yes, the momentum is lacking into the positive side. The support here at current 200 weekly exponential average will be very important in next few weeks to look out at. And if I just look at the next chart, again this is a weekly chart, and if these things happen, if we look at back in 2016-17 when index was trending above the golden cross, the slope of blue line, which is the 50 weekly exponential, was trending downwards, and the slope of orange line, which is trending upwards, has certain point in time met. The momentum lack over here has resulted in death cross. There could be a chances, or history may repeat, that the momentum may slope onto the southward journey onto the pharma index, and we may see a death cross. But yes, the hangover of golden cross is I think fizzling out. The momentum is fizzling out above the golden cross now, and if in case the history repeats over here with the death cross onto the weekly scale, that could be the sign of cautious for me, and I would say the bearish structure, the bullish structure may turn onto the bearish structure over here onto the weekly scale. If I just move on to the daily chart, as we are into the top down approach, uh, again a golden cross back in 2020 rally where the pharma index rallied by a faster pace. One of the outperforming index, as I said, 2021-22, we saw the momentum lacking, the golden cross turning onto the death cross onto the daily chart. Now generally, if I just look at the death cross, if you look at the first, this was a sign in first quarter of 2022 when the death cross happened. Right from the higher levels, the index started having the lower high, lower low structure, which is again a bearish structure as per the Dow theory. Second attempt, if you look at, prices tried to move higher, the averages moved trend to move higher, but again there was a failure. So again, death cross been retested, the failure of the golden cross, and we have seen the slope coming back downwards, the prices or the index falling back to the lower levels. Third attempt, back in November 2022, in the recent times, being seen a failure as of now. If you look at again, the slope of 50 has been onto the downside. There was a convergence. Now again the divergence has been happening onto the 50 and 200 onto the bearish side again. So the convergence is not playing out onto the positive side or resulting into the positive side, but in fact it is resulting into the negative side. So again the bearish structure continues onto the pharma space, onto the daily as well. The third attempt, even if you look at the rally which has been seen around 13,500, 550 level, being fizzling out, the golden cross is not convincingly moving higher. The convergence is not resulting into the divergence onto the positive. In fact, it is onto the negative. So again, this is a third sign where I believe with the weekly scale hovering between 50 and 200, the slope of 50 on the weekly scale, 50 moving average, exponential moving average is onto the southwards journey. Here the death cross is resulting, the attempt to take a golden cross is failing for the third time. Again, this is a chance of a bearish structure. Only important over here onto the daily chart is the recent from the recent low of June. The prices, the index is forming higher and higher low structure till 12,000 is not breached. Probably this structure may hold with the higher and higher low structure, but the death cross indicates that the probably we may see a downwards journey coming onto the pharma index. I would only look for a pharma index above 14,000 on a momentum based play. For a trend change, it has to be for a longer term trend change, it has to surpass the all time high, which was around 15,000 levels. So I'll keep a watch on these two levels, 14,000 for purely a momentum play and 15,000 for a long term trend change. It will surpass the double top approach onto the monthly chart once the highs are taken out. But till then, I think the momentum is on a shorter span in time. On the daily chart, I would say the trend is very, very bearish. Looking at the attempt it has made to convert from the death cross to golden cross. It seems that the bears are controlling the trend onto the pharma index. Well, if I just compare it with the broader market, where broader markets we have seen banking coming back very, very strongly, financials coming back very strongly, IT and pharma have been struggling. Still, markets are trending around the all-time highs. We have seen we are just around a few percent away from the all-time high, but pharma index, if I just look at, been down by around 15-18% from their higher levels. So if I just look at the next chart, Nifty Pharma by Nifty 500. So I'm looking at comparing the pharma index against the broader market share, which is Nifty 500, and this is again a weekly chart. Now, importantly, when we are comparing the golden cross and death cross, look at the structure. The green line over here is the 50 weekly exponential moving average, and the orange line again, which is a 200 weekly exponential moving average. Now, the reason to look at this ratio chart is comparing the pharma index performance against the broader market index. It means that when the blue line is going higher, the pharma index is outperforming against the broader market. When the blue line is sloping onto the southwards journey, it means that the broader market is outperforming, or the Nifty fund is outperforming against the pharma stock, which means that other sectors may be outperforming or other stocks may be outperforming apart from the pharma. If I just look at the slope at current point in time, it has been trending onto the southwards over here. 2020 we saw a spike. We are back to the levels of 2019 again. Once the red line is broken onto the downside, I am very much convinced that for next probably 2023, we may see pharma index underperforming by a huge margin in against the broader market space. So look at the death cross over here. We saw death cross coming in 2017 onto this ratio chart. It tried to attempt back in 2020 or late 2020, where the cross of 50, the green line, was there above the 200, but again it failed. Look at the slope now. Again, the convergence turning out to be the bigger divergence onto the negative side, onto the 50 versus the 200. So yes, the slope indicates that the underperformance may continue onto the pharma space against the broader market. And looking at the ratio, I believe the money making opportunities may not be into the pharma space. I'll slightly wait for things to turn out or the faster pace onto the pharma index with the positive bias. That may change the chart structure over here, but as of now I don't think that considering the broader market, pharma index is outperforming. Similarly, if I just look at compare the Nifty pharma index against the Nifty 50, which is the benchmark index, the similar structure, the death cross back in 2017, an attempt to give a golden cross, failure of golden cross, resulting into the death cross again. Now the slope or the underperformance of pharma index against the Nifty 50 seems that it is an avoidable sector as of now. As I said, the COVID cases may increase. We may see pharma coming back very, very strongly, but I'll wait for a confirmation of two levels: 14,000, 15,000, 14,000 for a momentum trades, and 15,000 as the change of trend from a medium to long term per se. These are the two levels I will watch for entering the pharma stocks. Till then, I think it is unavoidable. I don't think that COVID cases or the COVID rising cases may take the pharma stocks onto the higher side. But in fact, every rise have been opportunity to go short on the pharma space or the exit from the pharma stocks. And we have seen underperformance coming onto the pharma sector against the broader market, which is Nifty 500 and Nifty 50 both. So I'll wait. Again, keep in mind two levels, 14,000, 15,000 on the index to enter. When these levels are taken on technically, I would look for an entry. Till then, it is an avoidable sector. Signing off, Brijesh Bhatia.